Well, for more on how Egypt will affect trade here in the U.S., if at all, and also all around the markets around the world, I want to bring in JPMorgan's chief U.S. equity strategist, Tom Lee. He's with us throughout the hour. Tom, good to see you.
Great to see you, Betty.
Okay, so today, interestingly enough, the equity futures are higher. I mean, are investors here more focused on the U.S. economy than what's going on over there?
You know, I think Friday it was, kind of reminds us of what happened in the crisis, which was we sort of fire first and then aim later, But I think people kind of thought over the weekend.
But do you think Friday was the correction on this?
I think Friday was probably the worst of the response, yes. So I don't think this is the correction that we're all expecting. I think that Friday was sort of a sell-off, and I think we're going to start to see people sort of buy this dip. There's still a lot of inflows. I don't think this feels like it's spiraling into some sort of global crisis. And
why do you say that? What tells you that?
Well, I think that we can sort of see what the outcome here is. That there isn't a, this is a really at the core. It's really a response to sort of inflation, right? Inflation pressures building, and then there's a response to sort of need for regime change, right? And unless that there was a feeling that this was either going to kind of start to fall through other countries or domino to other countries, or it was going to disrupt trade, I don't think this is more than just a speed bump right now.
And certainly, we've been pointing out all morning long, Egypt is not one of the markets that would really normally affect global markets. There's not a whole lot of trade really being done with Egypt. It's not, not a major trading nation for us. So that impact could be blunted, as you say, unless we see this spillover effect. I guess the biggest effect would be on the oil markets, right? If we see a spike in oil prices, could that in fact be a catalyst?
That's right. Well, Betty, I think the break point really is if you start to get to that $120, $130 oil, we're going to be guaranteed to see a slowdown in the global economy.
Okay, but we're a long way off from that.
Yeah, so we still could sort of absorb a lot more increases in the oil price from here.
Then what is the correction that you are looking for? What is it?
Well, the correction, it's hard to sort of predict a correction, right? Because there's a lot of reasons corrections take place. The one that we're looking for is the one to correct the extreme bullishness that happened at the very end of December. And when we've looked at the data, whenever you had a really strong reading in bullishness, which was, in our case, it's the percent bulls, less bears from AAII, you've almost always had a correction within 2 months. But really, the more typical time frame is March, April. So we think you're going to get a 7 to 8% correction in the March-April timeframe. 7 to 8%. Correct.
A very fast correction?
Well, the shape and the duration are kind of unknown. You're going to have to watch how it happens. But for us, it probably happens from a higher level. We're thinking more from 1330.
From 1330, okay.
Yeah, on the S&P. So we want to buy this dip.
You want to buy the dip. But then, so what do you think is a catalyst, or what can you foresee as a catalyst for this correction?
Well, there could be multiple reasons. One simple thing is we know inflation pressures are building. And so we may start to see sometime in the March-April timeframe consumer spending slow from higher gas. We could see companies talk about commodity inflation hurting margins, and it raises a lot of questions about peak profit margins. We could see some sort of further tightening action, maybe some hawkishness from Europe, further hawkishness really, or something inflation related out of EM. And then,
But it's interesting, Tom, you're talking about inflation, because we just got inflation numbers today, for instance, the core PCE, which shows that, geez, there hardly is any inflation
muted, yes.
here.
That's right.
March and April, it'll change?
There's definitely a lag, yes. Inflation tends to be slower moving. We know that there's definitely food and energy inflation pressures building in developed markets. It just takes a little longer for us to see it in our supply chain.
Tom, you just got back, right, I think, from 2 weeks of visiting your clients. Is that the number one thing that they're worried about? What are they fearful of? Yeah,
investors are definitely worried about, well, actually what they're most worried about is that everyone's constructive, right? I think that their fear is if everyone's constructive, then
something's going to happen.
Yeah, so it never plays out in the way consensus views it. But the most obvious thing that they can see is really inflation building globally.
Tom, then, right before the break, you were saying institutional investors, right? They want to see more fear in this market before they get in. But do you get the sense, though, that they are on the cusp of finally, that we're going to see volumes increase, that finally these flows are going to come back into the equity markets?
Well, there are inflows. I mean, I think the retail investor is putting money in. Yes, and it's been hard to find investors who actually are seeing the inflows, but we know it's showing up in the tape because we see steady dip buying taking place.
Okay.
I think the torrent of inflows is going to happen this year, but I suspect it's going to be when we get a much more visible, all clear signal for the average individual investor. So I think that's going to be a couple of months of really big jobs numbers.
Okay, so the jobs will be key for the retail investor.
Correct.
And when we get back to this fear, am I making too big of a jump if I say perhaps what's going on in Egypt is going to rattle people in these emerging markets, coming back to the U.S., and we'll see more flows here? Is that a jump?
That's not a jump. In fact, I think that if you were to link it through inflation, I think the building of inflation pressures in EM is being met with monetary tightening. It's not usually a good formula for equities to do well. So I know normally you might say there's some sort of rule about initial tightening is good for EM stocks. Well, if it's happening at a time when global monetary policy is easy in developed world, you might actually see equity flows into developed world.
But you've also just mentioned inflation here in the U.S., though, so how's it any different for us?
Well, the Fed can tolerate inflation here. I think we can be patient because, one, we've really got, the Fed has two mandates, it's employment and inflation. I think price levels have really undershot for a few years. So we can sort of be comfortable with 3%-ish core for a couple of years here.
I got some emails. Is that 7 to 8% drop that you see in the S&P in March and April? Your target, let me look at it. It's 1425, right, by the end
Correct.
of this year. So how do you get from a 7 to 8% drop in March and April and climb even further back up to that target then?
Well, I think that whatever low we see sometime this year, so let's say it's 1250, I think you have to buy it. Because really, I think we're in an era where corporate share of economic growth has been growing, and I think that's going to be the story that dominates this year. And I think it means we're going to see top line accelerate in the second half. I think, GDP is accelerating. And, if you can imagine what's happening in the next sort of between June and year end is, potential for housing to bottom, employment to hit 300,000 a month. And then the whole notion that I think investors are going to focus on is, well, why is risk premium still at a 60-year high?
Right.
So I think it's all about PE expansion.
What do you make of this, Tom?
Well, I think both could end up being right, in the sense that...
oh, come on. That's so diplomatic of you to say. No, really.
But I think what will ultimately govern what St. Joe's does is what happens to the housing market. I think if you think about land value over time, even over 5 centuries, it basically tracks inflation. And we know that right now in the U.S. we have a cyclical oversupply of housing. So, I think if you've got a 5-year time horizon, I think big landowners are going to be big winners.
I know you're talking.
Bottom line.
You were talking about this earlier, but how much of your year-end call for stocks is tied to more improvements in the housing market right now? Just to follow up on that.
It's not central. In fact, I think it actually is a huge accelerant. If you look at housing, we built 500,000 homes last year, which is, 3 of the lowest months were all last year. Every 250,000 increase from there is 1 million jobs.
250,000 increase
is 1 million incremental jobs. Now you have to remember, 1
million incremental jobs.
Correct.
Wow, okay.
And remember, 1.5 million is basically household formation. So we're basically 1 million below where we should be, and we're about 4 million jobs less than we need to be. So it's if we see housing start to tick up to 750 or even 1 million this year, it's a huge upside to the labor market actually.
But what's going to lead? Is it the housing? I mean, it's got to be the jobs leading the housing market, though. Is it not?
It's chicken and egg a little bit. Yeah, I think that on the margin right now, what we're seeing, like what we can tell from looking at both credit markets and some of the trust data, is that early stage mortgage delinquencies look like they're going to fall sharply this year. Early this year, like in January, February. And I think that's going to be a pretext for banks to really start easing on mortgage credit. And so we should start to see some improvement in activity from that.
Guys, I'm surprised looking at the markets right now. I mean, we're pretty much, unchanged on the Dow, but, a little bit higher on the rest of the indexes. This Egypt news is really not affecting investors today, at least.
Not affecting investors today. You're seeing a little bit of a mixed reaction around the world right now. So is Israel's market actually bounced back? Abu Dhabi's market bounced back? I've been talking to traders, and they tell me a couple of things are happening here. there's been no progression in terms of what's going to happen next in Egypt. So unless there's some big step that happens, we may not see another reaction. Also, people using this as a buying opportunity. A lot of people tell me, look, this is very isolated to Egypt here. This is a good buying opportunity for a lot of these stocks that have been sold off and perhaps overdone.
We saw a bigger reaction, right, Tom, when we actually had the North Korean crisis late last year. What gives?
Well, I mean, I think part of it's the root cause. I think when you look at Egypt, you could trace the roots to sort of inflation and maybe some need for regime change.
Right.
I think when you sort of look at what happened with Korea, I think you have sort of a very erratic regime and the risk of this escalating beyond just a normal military confrontation.
Right. So this is not the black swan event, perhaps, or a mini black swan event.
That's right.
Right. No, that's what a lot of people have been telling me. This has been a long time coming. It was just a matter of when it was going to happen, not if it was going to happen. So not completely unexpected. I mean, things like this are always a little bit unexpected, but this has been kind of in the works for a little while.
Yeah. I think if this inspires other frontier countries to start social unrest because of inflation, that's when this could sort of really spiral.
Frontier markets like what, Russia or elsewhere?
Yeah, or Latin America,
Kazakhstan,
Okay.
Exactly.
You guys catch SNL on Saturday by any chance?
I didn't.
Did not? Oh, okay. Well, because the world's youngest billionaire, he was there. He tried his hand at comedy over the weekend. Facebook's Mark Zuckerberg showed up on Saturday Night Live, meeting the man who played him in this year's The Social Network for the first time. Here's how it went down.
So, yeah, it's good. I really liked you on 60 Minutes.
Thanks, man.
Yeah.
Thanks.
You ever end up seeing the film, the Social Network?
Yeah, I did.
Cool. Oh, thanks. What did you think?
It was interesting.
Interesting. You know what? I'll take it. Thank you. Great. Hey.
I heard some of the blogs were criticizing Zuckerberg that he was awkward, but come on, he's not an actor.
The guy's not an actor.
He's a billionaire. He doesn't care. Jesse Eisenberg is nominated for an Oscar for his portrayal of Zuckerberg, though. So anyway, so now you've caught it. Anyway,
Yeah.
Tom, thank you so much for being with us.
Thank you for having me.
Appreciate it. Tom Lee of JPMorgan.